The US government just crossed $39 trillion in debt. Not million, not billion, trillion, with 12 zeros. And I know what you're thinking. Cool, that's a government problem, not mine. My savings account is sitting right where I left it. Here's the thing. It's not. Every dollar in your savings account is a promise. And right now, the guy who prints the promises is $39 trillion in the hole. In the next 15 minutes, I'm going to show you exactly how that number gets from Washington, D.C. into your bank app, and what, if anything, you should actually do about it. Treasury building, stock ticker, calculator on a kitchen table. Let's set the table first, because national debt gets thrown around so much it's become background noise, like a check engine light you've learned to ignore. As of this month, total U.S. gross debt sits at $39.83 trillion debt actually owed to the public, meaning investors, other countries, pension funds, you if you own a treasury bond, is $32.1 trillion of that. The rest is money the government owes itself between different federal accounts. Here's the number that should actually get your attention. The government is now projected to run roughly a $2 trillion deficit this fiscal year alone. That's not the total debt. That's just this year's overspending added on top of everything already owed. $1 trillion plus paid in interest, FY 2025, more than the entire defense budget. And last year, interest payments alone, just the cost of servicing the debt, not paying it down, crossed $1 trillion. That's more than the US spent on national defense. So here's the frame for this video. I'm not here to tell you the sky is falling. I'm here to walk you through the actual mechanism, step by step, for how a number that big, sitting that far away from your life, eventually shows up as a smaller grocery haul, a weaker dollar, or a lower real return sitting in your savings account. Then I'll give you the protocol. What history says actually works when a government is in this position. And I'll close with the nuance, the reasons this might not play out the way the scary headlines want you to believe. There are three mechanisms that connect a $39 trillion government number to the number in your banking app. Let's go through them one at a time. Think of the federal government like someone carrying a credit card balance. When rates were near zero for most of the 2010s, carrying 20-something trillion in debt was cheap, almost free, historically speaking. But interest rates reset higher this decade, and now the average rate on that $39 trillion pile is about 3.4%. That doesn't sound dramatic until you realize what it does to a budget this size. Interest costs have nearly tripled since 2020, and the Congressional Budget Office projects interest will eat up roughly 14% of every dollar the government spends by 2028. That's the trap. Just like a credit card minimum payment, the government now has to keep borrowing more, partly just to pay the interest on what it already borrowed. That's not a conspiracy theory, that's arithmetic. The inflation release valve. Here's where it starts touching your savings account directly. A government with this much debt has, historically, three ways out. Grow the economy faster than the debt. Slow and hard. Cut spending or raise taxes enough to close the gap. Politically brutal, rarely fully done. Or, the quiet option, let inflation do some of the work. Inflation is basically a stealth tax on debt. If the government owes $39 trillion in today's dollars, and tomorrow's dollars are worth 20% less, that debt just got 20% cheaper to pay back in real terms. The government doesn't have to announce this. It just has to keep the money supply loose and let prices drift upward faster than your paycheck. And your savings account is on the losing end of that trade. If your bank pays you 4% and inflation runs 3%, you're only really growing your money by 1% a year. If inflation spikes, like it did in 2022, and your bank doesn't keep pace, your safe savings account is quietly losing purchasing power while the balance on the screen goes up. Mechanism 3, the confidence mechanism. The third mechanism is the one that actually keeps economists up at night. Bond market confidence. The U.S. government doesn't have $39 trillion sitting in a vault. It borrows by selling treasury bonds to investors, pension funds, foreign governments, you through a money market fund. Every auction, the government is essentially asking the world, will you still lend to us, and at what price? Right now, demand is still healthy. Auction bid to cover ratios are strong, meaning there's more than double the demand than what's being sold. That's good. But if investors ever started demanding a much higher interest rate to keep lending because they're worried about the debt trajectory, borrowing costs would spike further, deficits would balloon faster, and the Fed would face pressure to step in and buy more debt itself, which is another way of printing money. That chain reaction, rising rates, rising deficits, more money printing, is the scenario people mean when they use the word reset. Not that your bank account gets zeroed out overnight, but that the purchasing power of what's in it gets eroded faster than most people are prepared for. Okay, mechanism explained. Now let's talk about what you actually do with this information. This isn't personalized financial advice, but here's what history and basic financial math suggest about protecting yourself against this specific risk: a government slowly inflating away debt. Step 1. Don't let 100% of your safety net sit in cash. Cash and basic savings accounts are essential for emergencies. You still want 3 to 6 months of expenses liquid and accessible. That's not up for debate. But cash is the asset most directly exposed to mechanism number 2, inflation. If every dollar above your emergency fund is sitting in a 0.5% savings account while inflation runs 3%, you are guaranteed to lose purchasing power every single year. The protocol isn't abandon savings, it's stop treating your entire savings account as a long-term store of value. Step 2. Use instruments built specifically for this risk: I-bonds, TIPS, inflation-adjusted treasury instruments. The U.S. government actually sells you insurance against its own inflation problem. Series Y savings bonds and Treasury inflation-protected securities, or TIPS. Their return is explicitly tied to inflation, so if prices rise faster, so does your payout. It's one of the few places you can literally hedge government-driven inflation using the government's own paper. Step 3. Own productive assets, not just currency. Currency is a claim on value. Productive assets, stocks and companies that can raise their prices with inflation, real estate, income-producing investments, actually generate more of that value over time. Historically, broad equity markets have outpaced inflation over long time horizons, even through high debt, high inflation decades. That's the core logic behind "don't just save, invest." It's not a slogan, it's a direct hedge against mechanism number 2 and number 3. Step 4. Diversify where your dollars are exposed. This doesn't mean panic moving your money out of the country or into speculative assets because a YouTube video told you to. It means recognizing that a portfolio 100% concentrated in US dollar cash has a single point of failure. Some combination of domestic equities, inflation-protected bonds, and a genuine emergency cash buffer spreads that risk without requiring you to predict exactly when or how a reset would happen. Before you panic. Now, the part most debt crisis videos skip because it doesn't get clicks. The case that this doesn't play out as a crisis at all. First, the US dollar is still the world's dominant reserve currency. That gives the US borrowing privileges most countries don't have. Global demand for dollars and treasuries provides a cushion that, say, a smaller economy in the same debt position wouldn't get. Second, debt to GDP has been higher before. After World War II, US debt to GDP peaked above 100%. Comparable to levels debt to GDP is approaching again now, and the country grew its way to a lower ratio over the following decades without a reset. Third, the debt crisis is coming has been a headline for over 40 years, through multiple decades, where it didn't produce the collapse predicted. That doesn't mean this time can't be different. Debt levels, deficits, and interest costs are genuinely higher than most of that history. But it's a reason to prepare, not to panic. The honest answer is, nobody, not me, not an economist, not the Fed, knows exactly when or whether rising debt tips from manageable, if uncomfortable, into crisis. What we do know is the mechanisms are real. They're already measurably affecting the budget today, and the protocol I just walked through works whether the crisis scenario happens on a 10-year timeline, a 50-year timeline, or never fully arrives at all. That's why it's called financial resilience, not financial prediction. Recap. So to bring it all together, the debt doesn't reach into your bank account directly. It reaches you through interest costs, squeezing the budget, inflation quietly eroding what your cash is worth, and bond market confidence that could raise borrowing costs further if it ever cracks. The protocol isn't complicated. Keep an emergency fund, but don't let it be your entire financial plan. Use inflation-protected instruments where it makes sense, and own productive assets that can actually outgrow the problem. Frequently asked questions. Will the national debt affect my savings account? Indirectly, yes. Rising debt can push inflation higher over time, which reduces the real, inflation-adjusted value of money sitting in low-interest savings accounts, even if the account balance itself never goes down. What is the current U.S. national debt? As of August 2026, total gross U.S. national debt is approximately $39.83 trillion, according to U.S. Treasury and Joint Economic Committee data. How does government debt cause inflation? When a government carries large debt, inflation can reduce the real cost of repaying it over time. This can create an incentive for looser monetary policy, which increases the money supply and can push prices higher faster than wages. What can I do to protect my savings from inflation? Keep 3 to 6 months of expenses in accessible cash for emergencies, but consider inflation-protected instruments like I-bonds or TIPS, along with productive assets like equities, for money beyond your emergency fund. Is a debt crisis actually likely in the U.S.? Economists are divided. The U.S. dollar's reserve currency status and historical precedent, post-WB2 debt to GDP recovery, are reasons for caution against panic, but current deficit and interest cost trends are historically elevated. If this was valuable to you, share it with someone who needs to hear it. Financial education is one of the most important gifts you can pass on. Like and subscribe. I'll see you in the next one. Thanks for watching.